Okay, I'm gonna go through this chart. It's actually playing in real time. Um, the reason I want to go through this one is because this is not a typical trade that beginners can just identify, right? Like if you look at the price action, just like from right here, right, you can kind of see that price looks like it's just going sideways, right? So if you don't have much experience in, in this setting, you might not be able to identify the trade that's playing out in real time, right? You would not have been able to capture this entire move, right? Now, if you have more experience, you would know that this is actually a really good structure, and this is actually a trade opportunity. Now, a lot of people say it's choppy, it's sideways. It is true, it is sideways, it is choppy, but there is a way to identify this trade if you apply some concepts together. Now, I'm not going to go deep into all the different things you can use, tools, concepts. I mean, there's different strategies. I can apply a bunch of them. I really want to focus on simplicity and making this as simple as possible. So I'm going to show you how you could have identified this trade before it played out, obviously. Now, there's a lot of ways we can approach this. Now, I'm going to go through this relatively quickly. So first of all, I want to start from up here, okay? Because a lot of the times people are like, oh, you already know what's going to happen because you're doing replay, or because, yeah, I mean, it's replay, right? But honestly, if you're doing analysis and planning for the trades, you are able to identify where price can go and where, the price will be in the next few days, few hours or so, right? So we'll use this as an example. So obviously we already know that price went down here, but that's not the point of this replay. The replay is really to show you, is really to test if you can analyze the market and try to forecast what could happen given what has already happened, right? So obviously we can clearly see that price has been in an uptrend, right, for a period of time. If you keep zooming out further, you can see price has been in a clear uptrend, for a period of time. So during this time period, that price is continuing to go up. What you want to be able to do is identify, where can you buy, right? Now, obviously, if I had to, if we were all the way over here, or like we were up, let's say up here or up here, obviously these are going to be the buying opportunities, okay? So it's actually really important that you identify these as buying opportunities, not because not because these levels matter so much to you, because it already happened, right? The price is currently right here. Now, the reason why we want to understand, we want to identify these levels is because people were buying there, right? So traders were buying there, institutions were buying there, retail traders were buying there. Now, if we understand how the market moves, it really wants to take people out. I mean, it's as simple as that. The market moves based off liquidity, right? It likes to trigger stop losses, right? And so if that's the case, we have to identify where people were buying prior to price making its way up here, or up to this range right here, right? So what does that mean? We have to analyze not this. We have to analyze everything prior to that. Okay, so this is where analysis actually plays through, is over here, which is where has price been, right? Well, clearly price has been in a uptrend, but during that uptrend, how did we make our way up here? Did we go straight up, right? Like there's times where, for example, if you look at let me go through here really quickly. If you look right here, how did price go all the way down here? Did it staircase down? Did it go slowly down like this? Like did the price go like this? Did the price go down aggressively? Like those are really important because it tells you, what the market is trying to do, right? I'm going to explain what I mean by that, but I'm going to go back to this, right? So I think we started right here, okay? So why is it important that we label these lows? The reason why we label these lows is because these are where people were buying, okay? A lot of people were buying during this time period, right? So here we have equal lows right here. So this is most likely going to be taken out. So we use this low, and then we'll identify another one. We can use this one, and then we can use this one, okay? So what did I do here? I basically labeled these levels where people were buying, how do we know people were buying? I think it's an obvious answer, but how do we know people were buying is because if we look at the market like this, we can see the market went down, it went up, it went back down, and then it started shooting up, right? So during this time period, people were buying, okay? Which means right below these levels is stop losses, okay? So let's do that again over here. So right here, the price goes down, right? It goes down a lot, goes back up, goes back down, and then from there the price just keeps making higher lows, keeps going higher. So what does that tell me? That means people are buying at these lows right here, okay? Now it's important because in order to identify liquidity, you need to identify where there's a lot of stop losses, right? Where it makes sense for price to go to. Now, if you're a beginner, you don't actually know which one of these levels is going to be the buy, right? Now, when you're more experienced and you utilize higher time frame analysis, you'll be able to figure out which of these levels is the ones we should focus on, okay? Which is what I'm going to do, right? So clearly I'm on a 1 hour time frame, and that's where I'm kind of just identifying these swing lows, right? To show you where people were buying, where price, after reaching these levels, price immediately shot up. So now what I'm going to do is I'm going to go to a higher time frame to kind of get a more precise area, a better zone, and how to get rid of some of these levels, right? Because obviously we don't want to have too many levels because now it becomes you know, hectic, right? There's just too many things to focus on. Which one do I want to buy at? Do I want to buy here, 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 you know, etc. So let's go to a higher time frame. If we go on a 4-hour time frame, I'm going to delete these arrows because we should by now know what they mean. Okay, so this is current time, right? So what we could do right here, these two lows are going to act as liquidity. They're not really that strong. How do I know? Because when price, so this is where knowing how price moves is really important. So it's really important to know that price, the way it made its way here is it's staircased up. Okay, when you have a staircase, okay, when you have a staircase like this is all liquidity right here. Okay, so usually it's going to be these first two levels right here. These two, oops, these first two are going to be liquidity, especially when the price is staircasing. Okay, these are going to be liquidity, and usually right below that is you're going to have an area of interest or point of interest. It's usually going to be your demand, order block, etc. Right? And then obviously there's going to be a massive imbalance here, which a lot of people tend to focus on. Okay, they're like, oh, I'm going to buy when price goes below these levels, all three of them, right? But then what actually happens is price starts to retrace back down, and it enters their point of interest. But then they're like, oh, I'm going to wait for price to go here to my imbalance, right? But then what ends up happening is during this time period that you're waiting for price to come here, not only did price go down significantly, not only did it retrace significantly, it also left behind liquidity to the top. Okay, so what does that mean? That means that price is likely going to go take them out before even trying to fill in this imbalance, which means you can take a trade here. This is actually similar to what we're going to look at, which happens in real time. So it's going to look like this, okay? Which means you could be buying here and selling here. That's already a trade opportunity. And if you don't take that trade, that's a missed trade, right? Now, it's okay if you don't take it, but if you don't know how to analyze it, that's where it's a problem, because you have to be able to understand that there is a trade here, right? A lot of people ignore the charts when we're here. They're like, oh, I'm going to wait for the price to fill in this fair value gap, right? Maybe there's like an FVG right here, and then they're like, oh, I'm going to wait. It's not on my fair value gap yet, so I'm not going to enter. So that a lot of people tend to do that, when really the focus should have been on this green box, right? And that's what I'm going to do with this chart, because it's clearly what happens in real time. And so enough of that. Let me actually get rid of some of this stuff here. Or actually, I can't. Okay, let me get rid of this. So, okay, now that we've identified that these are staircases, that tells me that price is naturally going to gravitate to this level. Okay, now I could definitely draw a box here. I can draw a box here to kind of pinpoint where I want to buy. So this could be one of them. Now, I'm not really a fan of this box, so I'm going to go to an even higher time frame to see if this is really the box I want to look at. Okay, now I can see right here, this one looks pretty decent. I can go even slightly higher, try to capture more touches. So like right here, you can see we have support, resistance, resistance, support. Right, so just by going a little on the higher time frame, you can identify a key level right here, which happens to be a nice area right here. So if I was trying to buy, right, let me get rid of these two levels now. Now that I've identified, so let me go back to the time frame. I've identified these two as liquidity, which means price is likely going to take out both these people, right? So if that's the case, this is going to be my first box that I'm interested in. Now this could be a big box, which is where you can actually use a lower time frame to get a more precise box, right? So what we could do, so remember, before I even continue, this is a 4-hour box. I'm gonna be specific here. What we can do in this 4-hour box is we can go closer to where the swing low is and try to, what we can try to do is make the box a little nicer, right? And just like that, this is a 4-hour box converted into a 1-hour box. Oops. Okay, now this is still a 4-hour box. It's just within the 4 hours, there's a 1-hour box that's much more precise. Okay, what does that even mean? That means price is likely going to take out this level. So I could even draw my boxes a little lower. Okay, which still touches these points right here. The only thing I've done is made the box a little more precise. Okay, so this is one box. Now let's look at the next one. So it's between 49 and 50, right? Now let's look at it. Right here, you have equal lows. Okay, this is equal lows, which means this right here is liquidity. Okay, this is liquidity, which means price is going to take it out. So I'm not going to draw a box right here. It doesn't make sense to draw my box here. I mean, you can. I'm not saying it doesn't make sense. Let me rephrase. You can draw a box here, but it would be better to draw a box below it, because you want the liquidity sweep to occur below, right? You want the price to sweep below these equal lows, not, you know, you don't want to capture these touches when you don't need them, right? So what does that mean? Now that you know you have equal lows here, I want to identify, okay, if there's a sweep of this low, right? Let's say extend this. If there's a sweep of this low, how low can this price go? Can it go from here, or will it go a little lower than here? So that's what I'm talking about, right? So that's where your next box is going to be. So this is where you have to kind of actually look at the market more in detail on the higher time frame. The 1 hour is too low of a time frame to identify the key level here. So right here, you want to zoom out. So you have one box right here. Let's identify another one. So if I look at it, right here, I'm just going to draw a box here, because this is where I drew my swing lows, right? So I drew a box here. I can see right here, it doesn't look like a key level to me. I don't see like significant touch. Now if I drag it a little lower, I can see that it becomes a key level. How do I know? Well, look at this low, the price goes down here, but it closes up here, so that this is still a touch. You have support here, a deviation here, support here, deviation, support. So this is actually the key level I want to focus on now, right? So just like that, I'm able to identify a good box just by going on a higher time frame. Okay, so what I'm gonna do is drag this a little lower. Now I can see right here, if I go slightly lower, I can incorporate some more touches, right? And then it looks like right here you have some resistance as well. So this makes it even better. You have multiple touches, right? So now I can go back and drag the box to the right, and just like that, I've identified my 4-hour box. Okay, now this is a 4-hour box. Now what I can do is go in a lower time frame again. Honestly, you can even go between time frames. So this is a really good key level. And you can see right here, these are the equal lows, but right here you have a lot of wicks right here. So if you guys understand, if you have a lot of wicks, that means there's a lot of liquidity there. Okay, there's a lot of stop losses there because a lot of orders got. So basically, when you have these long wicks, that means a lot of orders got filled, right? And so when those orders get filled and price starts to go up, people start to place stop losses right below them, right? They don't want to lose money. They want to break even. So that's why stop losses tend to be at these below these wicks. Okay. So here, let me see. I'm gonna go back. Let's zoom in a little bit. So right here, I'm gonna delete these two because they're irrelevant now. So I've got 2 boxes. I have 2 key boxes, right? And because it looks like this box is a little bigger, I can even try to have more flexibility and make this box just as big, right? So now you have 2 zones to focus on. You're not going to focus up here because the price is, I mean, just look at where the price has been right here. This is a bearish fair value gap that got filled, right? So I'm not, and then the RSI is overbought. So during this time period, I'm not buying here. I'm trying to figure out where I want to buy, okay? So what I'm doing is identifying where price will want to take out these buyers. Remember, these swing lows is buyers. Buyers equal stop loss. Is that simple, right? Right here, equal lows, stop loss. So right here, I was trying to label it right here. You have stop losses, okay? Which means anywhere from here to here is where I want to buy, okay? I want to buy here or I want to buy here. Now, ideally, if you go to this green box, this is a key zone, right? If you look at my chart, I sent on the Discord, my boxes were actually a little bigger than this. They were actually going from, actually, let me go check because I don't want to draw the wrong box. It was from right here to right here, I think, or no, from right here. Yeah, my box was right here. My box on Discord was right here. Okay, this is also a very clean box. This is also good. Okay, so this is a big zone, but this is a higher time frame key zone. This is why when I was mentioning on the Discord, we were looking for consolidation, not an immediate move up. So I wasn't looking for price to just go here and go up. I mentioned in Discord, I want price to go here, consolidate a bit, show me some good price action, and then go back up, right? So this is also just as good of a box because you still have this liquidity here, which is still a part of the box, okay? So I'm gonna make it a little more precise. So this entire area right here is a good area to focus on. And let me see, let me just extend it and make sure this is good. Yeah, so right here you can see multiple touches. So this box is the best box I could make, okay? Now I'm gonna go really quickly here because I don't really see it here. We tap our first box. Look at this, okay? This is where this video might take forever, but here, my 4-hour box. Let me just show you what happens on my 4-hour box. Okay, the first one. Okay, so what happens on my first 4 hour? Did we not take this guy out right here? We did. Clearly we did, right? Right here you have a liquidity sweep, right? And then the price goes back up. So we took out this first guy right here that I labeled, okay? Right there, right? So we already see from up here to down here, the price took out these buyers, these people that were in, who, they got greedy, they didn't take profits, they placed stop losses, etc., right? So right here, we already take out these first few guys. Now this could have been potentially a lower time frame trade, right? You could definitely traded this. Now the price action looks pretty choppy, so I don't know if I would take this trade, right? But anyways, so as prices continue its way, this could definitely be a trade, right? You could definitely just target this FVG right here, but again, the price action on lower time frame seems a little choppy, so it might be just a short. Okay, what do I mean by that? What do I mean by short? Let me show you. You could have just identified this as a short right here. Okay, short the premium, fair value gap at the premium, right? Now, I'm not trying to go through all of this over and over, so I'm not going to go in detail here, but you obviously have a premium here, you have a breakup trend, or a breakup structure, you have a downtrend, right? So shorting the premium makes sense at this bearish fair value gap, right? So not going to look at that too much. We're going to look at this 4-hour box, okay? So right here, this is where I really want to focus on. So during this time period, right, we're consolidating at my 4-hour box. This is what I was mentioning. Now also, I did draw this on my chart on the Discord. I also identified an area of confluence. An area of confluence is essentially when you have your tools, your concepts that are aligning together, right? So this could be like a horizontal box, a trend line, a moving average, the RSI, MACD indicators. It could be a bunch of things that are aligning together to confirm, to give you a higher probability trade, right? So like right here, I think I drew my trend line somewhere here, right here. Yeah. So I can see right here, I have multiple touches on this trend line. So this is going to be like my key trend line. Now, why do you expect a reaction from here? The reason why you would expect a reaction from here is because look at the moves every time price touches this trend line. It's a pretty big move almost every single time, right? So if you have a big move almost every single time, don't you think we're going to have some sort of reaction, even if it's a small reaction, right? So that's the reason why I had my trend line here. So let me go back to the 4-hour time frame. So essentially this area right here, I'm going to label it just for you guys, is going to be known as an area of confluence. What we want to see happen in this area of confluence, in this area essentially, is we want to see price respect this area. We don't want price to go below it. We don't want to see price, just drop and break below it, right? So we're going to focus on this box. This 4-hour box is not just a 4-hour box anymore. It's our area of interest. It's a higher time frame key zone, okay? So this is an area where I was really focusing on, okay? Now, let's look at the RSI. RSI is already oversold during this time period on a 4-hour time frame, which means the likelihood of us going back up is very high, okay? It's just a matter of how the price action forms inside this area, okay? So let's just keep in mind the RSI is already oversold on a 4-hour time frame. So now we're just waiting for the 1 hour to give us a better structure, which I'm going to show you as I label these things really quickly. So right here, you have liquidity right here, okay? This high is going to act as liquidity. Right here, okay, so let me be more specific here. I'm going to get rid of this first box because this box was really just to show you, or I can leave it right there. That's cool. Okay, so before I even say anything else, look at what the price is doing, okay? The price had a significant drop, okay? Which means inside this area, there's a massive imbalance to the upside already, okay? Because the price went down, significantly in a short period of time, and it started going sideways, okay? So what does that mean? We have imbalances here, which means if you have an imbalance to the upside, eventually you're going to rebalance, right? Price is going to want to rebalance, okay? So during this time period, while price is consolidating here, I want to start to identify my zones. Right here, I can see that we have a clear supply zone, okay, order block. Over here, you have some gaps, right? I'm not going to label every single one of them. In fact, all you have to do is just draw this fit from this high to this low. Now, you want to see this low get protected, okay? So you don't want price to just start closing below this low that we've established, okay? So let's see how price action develops. It's actually kind of too early to even say anything, okay? But right here, we can see we have a little liquidity sweep right here into this gap. So we're not going to label that too much. I'm just here to show you what's kind of happening. Okay, so it looks like we're just ranging, right? Right here, looks like we're just ranging. Now, what does this look like? To me, this is just equal highs. Equal highs equals liquidity. So what is the market currently doing? It's generating liquidity right now. Okay, it's going sideways. It's generating liquidity down here, and it's generating liquidity up here, okay? So what does that mean? That means eventually the price is going to want to take out the people up here, and it's going to take out these people down here, okay? But because we're at a higher time frame key zone, the RSI has reset on 4 hours, we're looking for a move up to fill in all this imbalance up here, and then you have a supply zone liquidity here, okay? So during this time period, you can kind of see it's just ranging. A lot of rejections here, a lot of people are going short here. Remember, people are going short, 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 short. That is a lot of traders filling in their short orders, which means there's a lot of stop losses there. There's a lot of money there, okay? Which means the likelihood of coming up here is very high because you have imbalances, you have fair value gaps, okay? And then you have all this liquidity right here, okay? Now let's just watch it right here. Obviously, we see a nice reaction from our trend line, right? From this point in time, if I was going to trade this, okay, this is where you do need to have a higher time frame bias, okay? Because you might not know how to trade this because this is during FOMC, so this is actually not an easy trade to take, okay? But if you already have this understanding that this is a higher time frame area of confluence, you have a key trend line, you have a key zone, 4 hours is oversold, right? Here, let's go here first. For the big move, we can see the RSI is already oversold and it's aiming upward, okay? So if you were to take this trade, right, I would really recommend going on a 15 minutes, 1 hour to really capture this trade, because it is a choppy trade. It's not an easy trade. I will admit this is not an easy trade, okay? So we've identified all of this, right? We've identified where price can go, right? We've identified equal highs. We've identified a premium right here inside of our, we have a fair value gap inside our premium, okay? This is ideally where people are trying to buy. We can see that they're generating liquidity on both sides, okay? But because we have an imbalance up, we have more imbalances up here, a lot of untapped liquidity up here, the likelihood of going up makes more sense than going down, right? We've already gone down a significant amount, okay? So, and if you go based off market structure, you have a high and you have a lower high. And really, this is not even a lower high, this is what I call a weak high. But if price wanted to go any lower, it's going to want to go here and then go here, right? Form another lower high or something. Or if not a lower high, a liquidity sweep and then low, go low, okay? So from here, like I said, if I was going to take this trade, going to a 12-hour time frame, identify your protected low. In this case, this would have been my protected low right here, this area. So if I was taking a trade in this box, okay, I would go enter somewhere in here, stop loss below this low. Why? This is where it's really, really important to know why. Market structure, okay? A lot of people tend to just bullshit their stop loss. Now this is right here, okay? So low, lower low, lower low, higher low, okay? Boom, go higher. This right here is liquidity. This right here is protected low. Protected low means in order to maintain structure, you want to hold this low. You don't even want to touch this low. You want price to stay above it, right? The moment we break this low, we open touching this and touching this and touching this, right? This then will be the next level we focus on. But because this is our key zone, we don't want to lose this area, okay? This is our protected low based off market structure, okay? This is the low that was, this low essentially allowed this move up, okay? So this is our protected low based off market structure. So in terms of entry model, so obviously this is already playing on real time. In terms of entry model, I will admit this is a very difficult trade for a beginner to take. But if you're experienced, you know that there is a trade opportunity in here, right? So just understanding, so I'm actually gonna go lower. Let me just go lower time frame really quickly. Let's just analyze this. Okay, so we're on a 15-minute time frame. This actually might be a really long video, I'm not gonna lie. We're already at 30 minutes. But anyways, right here, have equal highs. Okay. My understanding of the higher time frame based off my markup. Now, the reason why this is taking a long time is obviously because I'm explaining a lot of things in detail. But my understanding of the higher time frame prior to price going up is that there's a lot of liquidity up here. There's a premium here that hasn't been touched. Based off market structure, we haven't established a lower high yet. Okay, so remember, like I said, there's two scenarios. Either reject this, or you sweep above this high, tap this supply zone, and then go down. It's one or the other, right? And we're probably gonna see this in real time. We'll see what happens in the next few hours. It's one of these. Okay. So we identify the equal highs. It looks like right here, this is really important. This is right here is your liquidity sweep. This right here is inducement. Okay, inducement, early buyers. Liquidity sweep, take out the early buyers. Okay, right here, equal highs, generating liquidity. Right here, draw a trend line. Right, you're breaking this trend line. So what would I do? What I do? Depending on where you are in time, I would consider taking a trade somewhere here. What I would do is draw this as my, I would draw this as my demand zone, right? Because it looks like price is ranging, so this becomes your demand zone, okay? And then if I see the RSI is oversold, I will take a trade here. Okay, let me open up my RSI, and okay, right here. In real time, if you're watching this, I'm not sure if you'll be able to identify this, but we are in, okay, so watch this. 15-minute demand zone, 4 hour slash 1 hour, or 1 hour slash 4 hour key zone. This demand zone is a part of our 1 hour, 4 hour key zone. It's not just a 15-minute demand zone. It's part of our higher time frame analysis. Okay. So right here you have a bullish, divergence, right? That plays out right here. So if you're really watching this, you might be able to capture this. But ideally, it's not even about the capturing. Okay, just watch this. Follow me. Right? We have this trend line. Okay, use this trend line to make observation of your entry. What do I mean by that? We're going to use this trend line to see if the entry that we got is good. Okay, we obviously, meaning we want to see price break above this trend line, right? And right above it. Now, the reason why this is also a good entry is because right above it is you have a untapped fair value gap. So either way, the price will gravitate to this box. Okay, so that's already a good thing. We're not placing TP here, okay, because we have equal highs, right? Equal highs acting as liquidity, right? So equal highs, liquidity, which equals magnet for price, or magnet, we'll just put magnet, right? It acts as a magnet for price. So if that's the case, we have a fair value gap here. Use this trend line to make sure your entry is good. So we want to see price break above this trend line. So if I was going to do this, entry here, stop loss below this low, okay? Now we have this fair value gap, which means we know price wants to come here. We also know price wants to come here. And because of our higher time frame bias, we know that there's much more gaps even higher than this level. Right? There's gaps here, gaps here, gaps here, right? Massive imbalance in price. Okay? Massive imbalance in price. which means equals price will likely come back here. Okay, so I'm just gonna write that down in this area. Okay, from this zone, boom. I don't want to make it too big. We'll do that, right? So just like that, this is a massive imbalance in price. There's a lot of fair value gaps, imbalances, so price will likely come back here. Okay, which means this markup should not take you that long, by the way. Now we're just applying the entry model, equal highs. We're waiting for price to generate liquidity, right? So the reason why we don't enter here is because there's not much liquidity to target yet. Okay, there's not enough price action. There's not enough structure to be like, yeah, price is just gonna go all the way up here, right? It doesn't really make sense for price to go from here to just go here, right? So that's the reason for why we needed to wait for price to establish structure, establish liquidity on both sides, right? You need to generate buy side liquidity and sell side liquidity. Okay. So going back to this, right? We're getting rejected here, and then right here. This is where trading has to be systematic. Okay. When you see this price action based off your entry, you might be inclined to sell because you're like, I don't know what's going on. I don't like it. That is very true. If you don't take this trade, that's honestly fine, because during FOMC, you're likely not going to be trading much, okay? But because we have a stop loss and we have a higher time frame bias, we're going to stick to that bias, meaning we either get stopped out or we hit our take profit. In this case, we haven't even taken out this equal highs, which means this is just manipulation. This is just, you know, an event going on during that session, during that day. So what we're going to do is we're going to leave our we're going to leave our, what do you call it, our TP up here, right? And so what you could do, and then put a box within this zone right here. Now there's a fair value gap here, so this might be a big zone. So just to make the chart simple for today, we'll just say here, we want to take TP here. Okay, and this is a 6, I don't even know, this is a really good trade, 6 to 1. Remember the stop loss here, or if you want to go based off the higher time frame, your stop loss is going to be around 47.70, something like that, which might be a little too much in leverage. So I would say just use this low, or even slightly lower, right, for flexibility. Now, this is just about being systematic, following the trade through, and waiting for price to go higher. Right here, price starts to go higher. Once the price is up here, put your stop loss at break even. There's no reason for the price to come back down and take you out and take some of your money, right? So, again, higher time frame bias is really going to help you in trading. And you can see right here, perfect reaction at the 75. We do fill in this 1 hour fair value gap that was formed right here. So I was already monitoring this trade, so I know exactly what it looks like. So right here, you have a nice tap of that fair value gap, which could have actually presented another buying opportunity for those who missed this trade, right? And from there, it looks like we're already touching this box right here. Now, if you look at it, this is just one key zone. If you look at what has already happened, okay, right here, this is also liquidity. So essentially, take profits. I would start taking TP here, hold some if you have conviction that price will take out these highs as well. Because if you do go, so I've already, like I said, I've done the analysis here. If you go on a daily time frame, you have a daily fair value gap just above around this area, which the price hasn't even touched. So if you have conviction and whatnot, you might expect price to go a little higher than this, right? And which is why I labeled this high right here as liquidity, right? Because my expectation was that price will take out this high to fill in the daily fair value gap. Okay, that's very key. Let me say it again. I'm gonna delete all this real quick. The reason why I labeled this high as liquidity is because right above it, there is a daily fair value gap right here that has not been filled. That's the reason why I labeled that high as liquidity, okay? Right here. So right here, I have this high acting as liquidity, and then going back to the daily time frame, you do see a daily fair value gap. Okay, so that's why my boxes were a little higher, and my expectation was we're going to take out this high. Okay, so hopefully that makes sense. The entry model really is where most of the work is, because honestly, doing this work right here should not take you very long. Okay, I mean, look at the daily time frame; it already reset. So really, what you're really doing on the lower time frames is just understanding. Look, we broke trend. I'm not going to use this trend. We'll use this one right here. Right here, we broke trend. We're clearly in a downtrend. Let's identify supply and demand. Right here. Boom. Right. Include these touches. Boom. Green box. And then, identify some fair value gaps. Identify some, some zones. Right here. This is our daily. Let me see. Our daily gap right here. Just like that. Right. That's all you have to do. Now you have an understanding of the higher time frame. And like I said, in here, this is lower time frame imbalance. Okay, so I'm trying to keep things as simple as possible right here. Lower time frame imbalance, daily fair value gap, and then demand zone down here, right? I'll write it down just because daily FVG, higher time frame demand zone. Okay, that's your demand zone. This is your expected low. Okay, and so from here, the reason why we knew from down here that price would want to go up here anyways is because you have a daily FEG and then you have lower time frame imbalances, right? If you go back to this, this is a massive imbalance. Price just shot down without even retracing back up here. So that's all it is, right? And yeah, I think this video is like 40 minutes. I don't even know. Yeah, 42 minutes. That's kind of crazy. Anyways, hopefully this makes sense as to how I applied everything. It's really just a mix of market structure and liquidity, right? And then from there, just utilizing basic tools like boxes and trend lines to really, monitor your entry and, to even get your entry.